A dealer friend of mine called me yesterday afternoon, and he was genuinely rattling. He wasn't panicking because the price dropped or because business was slow. He was freaking out because he has about 5,000 ounces of scrap silver, bent forks, old jewelry, damaged coins sitting in his safe, and his refiner just told him the lead time to process that metal pushed out from 2 weeks to 8 weeks. Think about that for a second. He has the capital, he has the metal, but he cannot convert it into a sellable form because the machinery is clogged. And I realized right then that while everyone is staring at the spot price ticker on their phone, the actual industrial plumbing that turns raw rock and scrap into money is grinding to a halt. And that is exactly why the price you see on the screen is becoming a total fiction. And I think you deserve the full story. So here it is. It is Sunday, February 16th, 2025, coming to you on Chicago time. Comment what day and date you're watching from, because I'm always curious how far this travels and where you are in the cycle when you hit play. Quick thing, I'm running a campaign to eliminate copycat channels. If you value this breakdown and the work that goes into connecting these dots, support it by subscribing and commenting "broken supply chain" below so the algorithm knows who the actual humans are. Here is the problem. The headlines and the experts love to talk about mining supply deficits. They love to show you charts saying we dug up 800 million ounces and we used 1 billion ounces. That is the simple math that fits on a bumper sticker. But the real story is the bottleneck in the middle. It doesn't matter how much ore you dig out of the ground or how much grandma's silverware gets sold if the processing plants, the refiners, cannot melt, assay, and stamp it fast enough. The mainstream narrative treats the supply chain like a teleportation device where metal goes from a mine in Peru to a vault in New York instantly. But the reality is that it is a messy, dirty, slow industrial process that is currently choking on its own volume, which means we are seeing phantom tightness where metal exists but cannot be accessed. And you don't hear that part in the mainstream narrative, because talking about refining margins and chemical processing capacity isn't sexy enough for financial TV. I'm going to break down 3 things for you, and I'll keep it practical. First, I want to explain the Dore Bar Lag and why mine output is not supply. Second, we need to talk about the scrap market illusion and why high prices might actually break the system temporarily. And third, I want to discuss the industrial priority list and where retail investors like us actually stand in line. Before we get into the details, let me say something to newer people, or if you're just getting started. Don't let anybody shame you for asking basic questions about how a bar gets made. This market moves fast, and it punishes ego. Most people think silver is silver. It's not. Until it has a stamp and a purity assay, it's just a rock or a piece of trash. And for the experienced traders watching this, here's a retention trick. Whenever you see premiums on physical products rising while the spot price is flat, ask yourself one question. Is this a demand spike or a supply clog? Because a demand spike is temporary, but a supply clog is structural. Let's start with the first major point, which is the processing choke point, or what I call the Dore Bar Lag. The principle here is simple. Potential energy is not kinetic energy. A mine does not produce a COMEX deliverable bar. A mine produces a Dore bar, which is a nasty, impure brick of mixed metals. Maybe it's 80% silver, some gold, some lead, some zinc, and a bunch of other garbage. It is useless to a tech company and useless to an investor until it goes through a refinery. The mechanism is like a funnel. You have hundreds of mines all over the world dumping these impure bars into a very small number of accredited refineries. These refineries are the gatekeepers. They have a maximum throughput. They are industrial factories with furnaces, chemical baths, and environmental regulations. They cannot just turn a dial and double production overnight. If a furnace goes down for maintenance, or if they can't get the chemicals they need, the flow stops. What we are seeing right now, based on the latest industry updates, is a widening delay between mine production and refined output. The metal is coming out of the ground, but it is stacking up at the refinery gates. It's like traffic trying to merge from 5 lanes down to 1. The cars are there, but they aren't moving. This creates a disconnect. The paper market trades the theoretical existence of the silver. The physical market trades the refined bar. When the lag time stretches from weeks to months, the paper price loses its tether to reality. Here is the hidden consequence. As this backlog grows, the available inventory numbers start to lie to you. You might see reports of mine production holding steady, so you think supply is fine. But if that supply is stuck in a door bar, sitting on a pallet, in a warehouse, waiting for a furnace slot, it might as well not exist for your purposes. It cannot cover a short position. It cannot be delivered into a futures contract. It is phantom supply. The common mistake people make is assuming that logistics are instant. In the age of Amazon Prime, we think we click a button and stuff arrives. In the commodities world, stuff moves on boats, then trucks, then through customs, then into a furnace. It is slow. And right now, the system is creaking under the strain. Now here's the skeptical alternative. Could this just be refiners managing their books to keep premiums high? Could they be withholding supply? Sure, that's possible. It's a business. But looking at the energy costs and labor shortages they are dealing with, it looks more like genuine incapacity than a conspiracy. Both can be true, but the incompetence of the infrastructure is usually the safer bet. That brings us to the second thing, which is the scrap market illusion. This is counterintuitive. We are told that higher prices bring more supply because people sell their old jewelry and silverware. That is true. But here is the mechanism that nobody talks about. Scrap silver is the hardest, dirtiest, and least profitable thing for a refiner to process. Gold scrap is easy. You melt it, it purifies easily, and the value density is huge. Silver scrap is bulky. To get the same dollar value of refined product, you have to process 80 times the weight of material compared to gold. It eats up furnace time. It eats up chemicals. It eats up floor space. When the system gets stressed, refiners will actually stop taking silver scrap or bid the price way down because they don't want to deal with it. They would rather use their limited capacity for gold. Recent anecdotal evidence from dealers across the country shows that the spread on scrap is blowing out. Dealers are offering 20 or 30% back of spot for sterling because they don't know when they can get paid on it. They are becoming storage units for scrap metal because the refiners are saying don't send it to us yet. The hidden consequence here is that the secondary supply valve, the scrap market, is being welded shut. Usually, when prices spike, scrap floods in and cools the market off. But if the refineries are backlogged, that scrap cannot enter the market as pure 999 investment bars. It stays as bent forks. So the price signal fails to bring new supply online. It creates a situation where the price can run much hotter and much longer because the natural braking mechanism is broken. Here's a question for you. If you were a business owner running a refinery with limited capacity, would you prioritize the gold shipment worth $10 million that takes 1 day to process, or the mountain of silver scrap worth $1 million that takes a week to process? It's simple economics. Drop a comment if you think the silver market is being ignored because it's just too much work for too little profit. Now add the third ingredient on top of that, which is the industrial priority list. This is where the rubber meets the road for us as retail investors. We like to think we are the customer. We are not. We are the nuisance. The real customers for the major refineries are the industrial giants, the solar panel manufacturers, the electronics companies, the medical device makers. The mechanism here is contract fulfillment. Samsung and Tesla have long-term contracts with major refiners. They have booked capacity months or years in advance. When the bottleneck happens, who gets bumped? It's not the trillion-dollar tech company. It's the private mint that makes rounds for stackers. It's the jewelry supplier. What we are seeing right now is a bifurcation in availability. The industrial 1,000-ounce bars are moving directly from refiner to factory. They aren't even touching the open market. Meanwhile, the blanks and grain needed to make retail coins and bars are becoming scarce. This is why you see premiums stay high on Eagles and Maples even when spot drops. The mints cannot get the blanks because the refiners are too busy fulfilling industrial contracts. The common misconception is that if industrial demand falls, there will be plenty for us. But industrial demand is inelastic. They need the silver to finish the product. They will pay whatever it takes. We are the ones who are price sensitive. We are the ones who get squeezed out. Now let me give you the uncomfortable scenario. Imagine a situation where the spot price of silver shoots to $50. Everyone gets excited. You go to your local coin shop to sell some of your stack to lock in profit, and the dealer says, "I can't buy it." Not because he doesn't have cash, but because his refiner isn't buying from him. The liquidity chain breaks. You have an asset that is theoretically worth a fortune, but the bridge to convert it back to currency is closed for construction. This is a liquidity trap. It happens in real estate, it happens in bonds, and it can happen in physical metals during extreme bottlenecks. Here's the twist. There is a world where high prices actually make the shortage worse. It's the paradox of plenty. If prices go high enough to trigger a massive wave of scrap selling from the public, that influx of material could completely overwhelm the refining capacity. It would be like a run on the bank, but in reverse, a run on the processing plant. The system would choke on the volume, causing spreads to widen even further. So the higher the price goes, the harder it might be to actually realize that price on physical metal. So here's what we covered. The mining supply numbers are irrelevant if the refining capacity is capped. The Dore Bar Lag creates a phantom supply that can't be delivered. The scrap market, which usually balances the price, is being deprioritized because it's too much work for the refiners. And the industrial buyers are cutting the line, leaving retail investors fighting for the scraps. Stay thoughtful. Don't chase the headline number. Watch the flow. If the metal isn't moving, the price is wrong. Now here are my questions for you. Have you tried to sell any scrap or damaged silver lately? What kind of buyback price were you offered relative to spot? I want to see the data points from around the country. Drop your answer below and remember to include what day and date you're watching from. If you want to support this channel and keep this campaign strong against the copycats, subscribe right now and comment "Broken Supply Chain." And if this helped you, share it with someone who thinks digging a rock out of the ground is the same thing as money in the bank. All right, take care of yourself, stay sharp, keep your head clear, and I'll talk to you soon. And just so we're crystal clear, this is educational commentary. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. You make your own decisions, and you own the outcomes. Do your own homework. Consider your situation, and only take risks you can actually live with.